Hey guys, Tim Melvin here, and welcome to the Real Income Report Weekly Update. It is the week of October 21st, 2024. We don't have any new reports or earnings reports or anything like that to talk about. So we're just going to kind of go over general concepts and ideas and get ready for what's going to be a busy 3 or 4 weeks coming up. So here we are, the S&P 500. We're off a little bit today. I'm not even quite sure what reason they're giving today. But it really doesn't matter what the reason is. While I was up in Orlando at the Money Report this last week, I had a great opportunity to talk with Jonathan Hoenig of CapitalistPig.com. Now, I've known Jonathan for a very long time. We met at a party of gathering of speculators, traders, and investors up in New York a really long time ago. I'm going to say 20 years, maybe more than 20 years ago. We stayed in touch, but I hadn't seen Jonathan in a while. He's got a new book out. It's Hoenig is the way you spell his name, and it's I think it's called The Price or something along those lines. But his point was, and it goes to something that we talk about a lot, when you're looking at asset classes, at the world in general, price is what matters, right? The trend is what matters. You can ignore all the information, whether it was because Elon Musk blew up a rocket ship, or Donald Trump said he was going to cut taxes, or Nvidia had a monster quarter. It doesn't matter what the reason is. Stocks are in an uptrend, with the exception of this little blip about a year ago, in 2023, where we went under this 50-week moving average for about that long and immediately opened back over it. With the exception of that, we have been there we go, jumping ahead on slides, in an uptrend in stocks since spring of 2023. So, I mean, you're 18 months into a really strong bull market. Conditions continue in spite of a little bit of pullback today. And this is, by the way, is why I just don't think that there's a tremendous amount of value in looking at the shorter term charts. Lots of noise in short term charts here. We've been in an uptrend for a long period of time. So, all right, let's go to this one. The slide deck obviously wants to go here. This is iShares US Real Estate Exchange Traded Fund. REITs had been in an extended bear market. This goes all the way back to 2022. So the market tops, comes all the way down in, bottoming down here in late 2023, and finally breaks over and changes trend. Almost a year ago, almost a year ago, which is a week of Halloween that this happened. So almost a year ago, we're coming right up on that. We entered an uptrend, chopped around a little bit here, and got right back into it and just continued to move higher. Now, traditionally, when you get these longer term bear markets like this, and this has been a pretty good one for real estate. Real estate markets have kind of floundered since 2020 for the most part. And of course, you had the banking crisis where commercial real estate was going to cause the collapse of Western civilization, and everybody was going to default, and all the loans would go bad. You still hear that one, by the way. If you just carouse around the internet long enough, you'll find articles about how Bank of America has so many bonds they're sure to collapse. Never mind that those bonds are repricing higher with the move down in interest rates. But this is what we're looking at. Real estate is now in an uptrend. It's been in an uptrend now since convincingly since May of this year. First started back in October of last year. So finally, real estate's moving higher. We have a long way to go. Traditionally, you get 2 or 3 years of outperformance when real estate markets put in a bottom like this. When you look at the private real estate markets and private transactions, prices are still quite depressed. There's a long way to go in this real estate recovery. Here's your 20-year Treasury bonds. Now, this is interesting. Lower interest rates paved the way for higher real estate returns. And of course, it's been the dramatic rise in interest rates that caused all the problems to get worse. And we began to have the perception that nobody was going to be able to roll over their loan and it was going to be a disaster. I mean, the truth is the concentration has been in downtown office buildings in select cities, and even that's actually starting to get a little better. But right now, interest rates, after this brief trend here, when it became clear that, hey, the Fed's serious, we're going to see a rate cut. So rates started going down, bond prices started going up. Now we've pulled back. And this is, well, it's a couple things. It's a fear that inflation might come back because we cut rates, but by 50 basis points, but the economy's not that bad. And, we got another strong jobs report. Look, I know all about the 818,000 jobs that were removed from the report. Truth of the matter is, jobs market's still pretty good, even after you yank those jobs out. Unemployment's fairly low. There's immigration remains fairly robust for legal immigration, which is creating, some job growth. It's the picture's not as bad as they're telling you. And you can tell, how do you tell that? The price, right? Wage growth is still happening. It's slowed down a bit, but unions are still winning good contracts. I mean, just go back and look at that contract that the Longshoremen's Union got on the East Coast. That was a huge pop in pay. So price, wages are still going higher. So there's still some fear of inflation because the economy's not terrible. Now there's signs of weakness, but there's also signs of strength. And there seems to be a perception that, hey, maybe this whole inflation thing's not done. And oh, by the way, we have massive potential inflationary geopolitical risk, right? A war between Israel and Iran, it isn't going to be good for oil prices. There's no other way to put that. And it can also impact huge chunks of the global supply chain. Then we just have the general distrust, right? There's been way too much debt ceiling, way too much talk of shit on the government, a total inability of the two parties to compromise and get a longer term budget deal done. Then there's just so much noise around the election and how this is going to turn out. And the fact that we continue to spend at a deficit every year and there's no end in sight. The debt just continues going higher. Now, I could have said the same things in 1990. I always make this point that this does not necessarily spell the immediate end of America, right? Because this has been true for a very long time, and it's not going to matter until everybody completely loses faith in our ability to repay the debt. We're nowhere close to that. But investors are saying, I can do 5% still in the money market. So I'll tell you what, you need to pay me this higher amount if you expect me to buy longer term bonds. So we have seen some backing and filling in interest rates. We'll be watching that closely. The trend has gone back to negative once again. We're now in the longest bond market drawdown from peak to valley, where it just came down and has not recovered the previous high. Probably gonna, if we use that definition, we're gonna stay in a drawdown for a really long time, simply because the high in price in bonds was set in August 2020 because interest rates were effectively zero. And I don't think we'll get back to that. Hopefully never, because what it would take is a disaster along the lines of 9/11, the great financial crisis, or the early days of COVID to get us back to anywhere near those highs. But bonds, another failed downtrend, back in a downtrend. We'll see if we recover anything at all this week. But we've been in that for 50 months now. So we'll see how it breaks out. I mean, eventually the Fed keeps lowering rates. We've got to see some relief, particularly if the economy does start to slow down. But bonds have been in a bear market for a very, very long time. That's been one of the factors that have depressed real estate prices around the country. But as I said, look, consumer spending is pretty strong. And if you go across by category, what's down? Gasoline stores, duh. Energy's down. Gasoline prices have been dropping. I was up at Orlando had sub $3 gasoline. I mean, it's like I wish I'd bought more cars with me so I could fill them up. If furniture prices are down a little bit, electronics and appliance stores, we do still have, and it continues to develop, where consumers are saying, hey, that big stuff, I think we'll hold off just a little bit longer here. But you could see stores, clothing, health, personal care, food and drinking places, general merchandise, they're still spending. Okay, so consumers have not completely thrown in the towel. The hard data remains pretty good. The soft data is, kind of ugly. If you look at consumer sentiment or small business sentiment, it looks, very depressionish. But they're saying they're depressed while they're out shopping. So, I said consumer spending actually remains pretty good. It is a busy, busy week for data this week. We have the Philly Fed, the Richmond Fed. We have existing home sales, which are going to be terrible, by the way, not because the market's awful or there's no demand. There's plenty of demand. There's no houses, and we've talked about that several times. There's a lack of inventory because 60% of all homes have a mortgage under 4%. They got no interest in moving or refinancing, and mortgage rates have gone to 7%, and that's just created some reluctance to buy. It's Chicago Fed national activity. Only geeks like me look at that one. But then you've got jobless claims. You've got the manufacturing and services PMI, both for the United States and global. New home sales, where we would really love to see an uptick in that, but we'll see. It's the tail end of the buying season. We get ready to go into late fall and early winter now, when it does tend to dry up a little bit as people get ready for the holidays. So you've got consumer sentiment and inflation expectations. At the end of the week, we'll see where those are. A busy, busy week. Lots of noise. As usual, we will do our best to ignore most of it. We'll see how that goes. Home prices, they're still going up. Right now, coming through October 13th, up 4.7% year over year. You think, wow, 4.7%, that's not terrible. Guys, the long-term trend line on housing prices is 1 to 2% a year. And this isn't just listing house prices. This is cash. This is the deal got done. The transaction happened. Prices are up 4%. So we're just kind of growing right along in the housing market, which continues to price people out of the rental market. And this slide is way out of line, so we're going to come back to that one. This is creating demand, guys, for multifamily, and I'm not sure what I did with this slide. Sorry about that, but not this one. Gotta go back. There we go. This is creating demand for multifamily housing. You've got a whole bunch of people that would love to move, but there's not enough inventory in the market. Prices remain very elevated. Mortgage rates are high. So you've got a whole bunch of new family creation and moving out, getting your first apartment and your first really good job, and getting out of mom and dad's house. You got that whole wave of folks coming up, but you got a wave of folks that are just stuck, that they would love to get out and buy a house, but there's affordability and inventory issues. So you've got a logjam that is keeping apartments at very high occupancy rates. Now, if you look at real estate, and this is office, and I said I messed these slides all up, but if you look at office real estate, the leasing pace is picking up, guys. I mean, this is like the rock bottom here in Q3 2020. It's just been picking up. We're not back to pre-pandemic levels yet, but we are heading that way. And these, by the way, are stolen from Jones Lang and LaSalle Research. They do a fantastic job. Office inventory removed. Another important slide that we don't talk about. A lot of office supply is slowly but surely being removed from the inventory pool. It's being demolished, it's being redeveloped, or it's being converted into apartments and condos in cities all over the country. So again, we're shrinking the pool as demand slowly returns. Most people are back to at least a hybrid work arrangement. In cities like Manhattan, you're like, nope, come to work. We're done with this. We need you in the office. We're starting to see that out west in the hard hit cities like San Francisco and Seattle, because they're tech heavy, and AI is proving to be a very hands-on operation. You got to be there in the room collaborating. So we're starting to see some back to work in those hard hit cities as well. So, if you look at the key takeaways in office, demand is still improving. Now, the interesting thing about demand is people have had time to adjust from 2020. They've gone through the cycle of nobody coming in to some people coming in to a new policy that's starting to work, starting to get an idea of exactly how much office space they need. They're signing longer leases. Now, particularly in Class A real estate, we're seeing availability start to decline. You've got some buildings coming out of the pool, although those are mostly B and C properties, but they're starting to fill up. They're taking tenants away from B and C, and there's not been any new development to speak of at all. Rents and concessions, not going up. They're not having to do a lot of concessions to fill the buildings, but people are looking around. They're saying, I've got to renew my lease. Where am I going? I'm in a B property. I can get into a C property without a big step up because of where the market is. I'm going to do that. So we are starting to see some decline in availability in the larger gateway markets across the United States. Industrial, this is your warehouse and industrial and supply chain real estate. You know, vacancy rate is minuscule. It's just been dropping since 2008. Amazon and other e-commerce has an enormous amount to do with this. Also, you can see it accelerate again at 2020 because everybody figured that just in time from a central distribution network center wasn't good enough when there was a crisis. And so we've seen more people moving into local inventory space, and we haven't seen any new supply come online to fill that demand in the local areas. It will slowly but surely, but in the meantime, the occupancy rates are staying very high in the industrial segment as well. Multifamily. Now, here's what's interesting. We talked about the supply-demand equation in multifamily, and it's quite bullish. Now, a lot of folks went out, were planning, talking to their banker, talking to the finance people. The wave that came on in 2023 filled up like that because of the affordability crisis. The wave that came on in 2024, well, a funny thing happened on the way to the forum. As that second wave, as the waves filled up 2023, bankers got less comfortable with bringing a whole bunch of new supply on. So did other commercial mortgage lenders, and we saw fewer deals getting done. So units under construction is shrinking. Demand is high. It's remaining elevated. We create new demand almost every day, and you've got the inventory and new supply shrinking. Which is very bullish. We'd love to have more multifamily if we could just get that little whack of a correction that would allow us to do so. We have a strong presence in the Big Five portfolio in the free section of the Real Income Report. And, we recommend that you do have that in your portfolio. We have Independence Realty, and we would love to have more, but remember, yes, we're, fundamentals based. We're very credit focused, but we're also very valuation focused. So we got a couple legs of the stool. We need a third leg of the stool to be there to fully prop up the investment opportunity, and we'll add more multifamily to the portfolio. Here's the most important thing that I really want you to seize onto. I want you to remember this. I want you to write it down. I want you to have it tattooed someplace where you see it often. Since 1972, when Sam Zell and a few other folks shoved through some tax legislation that basically remade the real estate investment industry into what we have today. So we're going to use 1972 as our starting point. We're going to go all the way up through 2022, and we can go all the way through today. This is from a Morningstar slide. And it continues to be very, very true. The top performing asset class has not been stocks. It has not been small stocks, large stocks. It has not been international stocks. It has not been bonds. It hasn't been junk bonds. It's been real estate, specifically real estate investment trusts. REITs, by a wide margin, have outperformed the S&P 500 continuously over the last 50 plus years, 52 years, often with a lot less drawdowns, and they tend to zig when markets zag. If you go back and look at 2000, 2001, 2002, 2003, real estate was just kind of rolling along double-digit returns while the stock market was absolutely falling apart. Now, 2009 was a real estate specific kind of, crash correction. So it did not fare as well. But if you go back to the crash of 87, if you go back to, the ugliness that was the 1970s, generally speaking, as stocks fell apart, REITs did very well. So I get a kick, and I said this in my presentation at the Money Show. I get a tremendous kick out of the asset allocators that say, hey, you should have 60, 70, 80% of your money in stocks. Heck, maybe you should have all your money in stocks, and you should not try to pick stocks. You buy the index and you sit on it, and all these wonderful things are going to happen. Okay. But if I just put it in a portfolio of REITs, I would have done better. So, yeah, it's, 5-10% of your portfolio in REITs? No, it should be much longer. I can make you one of an argument that you should flip all of this around, especially if you're getting closer to retirement. 50-60% of your portfolio in REITs with, a good dividend track record, great credit, and a great prospects for increasing the dividend over time. And the other 40-50% in fixed income opportunities that are throwing off large interest rate, large cash returns, and also trade at discounted values. That helps a lot. Would be a much better solution and would outperform what you might be able to get in the stock market, especially today. And we've talked about this and we've kind of beat the drum, and I'll do it more, but not today, where the 10-year forward returns from here don't look great. And if you go back and you look at the free copy of the President Money Show presentation, I go into detail on this. I mean, it doesn't matter if it's the aggregate allocation to equities, the excess CAPE yield, the CAPE yield in the raw, so to speak, or market cap to GDP. All of these are suggested we're at very elevated levels. Forward returns are probably going to be less than stellar. We don't know how that happens, right? Are we going to have a crash? Maybe. Could we go sideways for 10 years? Truly, I hope not. That's brutal. Or we could have a blow off top, which is kind of the most likely scenario from here, I think, which means we're going to have a crash, by the way. Where we have a blow off top and then come back down to reality, giving us a very forward return. Is a technical term. I would prefer a crash, would be my ultimate, because then we could just get a whole bunch of cash to work and just unbelievably attractive asset prices, which is why we probably won't get one. But anyway, the important thing I want you to remember and just hammer home, real estate investment trusts have solidly outperformed stocks for more than 5 decades. I expect that to continue to be the case. So anyway, again, this is the Vanguard Real Estate Index. We're not being overly aggressive right now. I mean, we're not like hammering it home. And if you come through here and you look, you come back here and you look in 2023, you were just ridiculously oversold. Nobody loved real estate. We chopped around in here for a period of years. This was a great time to be an aggressive buyer of real estate. You were trading at, a couple standard deviations below that, in my opinion, most important 50-week moving average. Your momentum was, negative to the extreme. You were extremely oversold. If you could just model these real estate investment trusts based on credit, and buy those with strong credit, good markets, with good histories of paying dividends. I mean, let's face it, guys. If you've got a REIT that has paid a solid dividend for over a decade now, they've been through the and managed to maintain that payout. So they are financially strong enough to deal with just about anything the market's going to throw at them. And some of these REITs have 25, 30, 35, and 40-year dividend histories. So we're in a nice, strong uptrend. It's not time to be the world's most aggressive buyer in real estate investment trusts. We are not even close to thinking about being a seller. You can see here that you do get into overbought levels, which ordinarily might have us, well, maybe we like it, but we're coming off this just really long downturn for REITs, and valuations are still quite compressed. And I think the upside from here remains phenomenal. Okay, and just here's our REITs. Here's your price to net asset value calculations over here, which is another reason that we remain pretty bullish on REITs. When this market is really coming into a period where it's like, oh man, we got to get out. You're not going to see these. These numbers are all going to be printing up really close to 1 or even over 1, at which point, generally speaking, I'm a seller. And they're like, well, only at 1, don't you want to wait? I mean, look, the highest number in here is 85%. So, I mean, we're doing really well. If this thing goes from 85 to 1 and we're collecting a 5-6% dividend, we'll take that. And by the way, that thing's already up quite a bit. So That's kind of, where we are right now. We like all of our REITs on anything that looked like a pullback or that was weak, like Park Hotels, anything that was pulling back, Apple Hospitality. I think you want to be a buyer of that, but you don't want to be a super aggressive buyer of everything across the board. Remember, one of the keys to what we do is we believe in and practice making volatility our very best friend. We want to buy when everything's going down and everybody hates them. Nobody loves them. We want to be buyers. When they're going back up, we want to hold. So that's where we are right now. And here is the income portfolio. We remain just incredibly happy with the whole portfolio. It's 7.9, about an 8% yield off this portfolio, but we really need to go back and do kind of a blended yield because all of these are up since we originally bought them for the most part. And some of them, like the Vornado Preferreds, are up quite a bit. So that had a blended yield of over 8. Kane Anderson was over 8. Intercap was a couple percentage points higher. So Pebblebrook was almost 9. So the real the real yield on cost in this portfolio for original subscribers is probably closer to 9. Same philosophy here, guys. If it's moved, we've done the credit analysis. We know we're money good in these things. We don't feel like we're taking any real financial risk at all. So if price creates opportunity, then that's when you want to move and add these positions to your portfolio. Remember, volatility can ruin your life or it can make your life. I choose B, and I think you should too. We're going to use volatility to give us an opportunity to buy credit-worthy assets at great prices, allowing us to lock in higher yields, both in the total return side and in the income side. So that's what I have for you this week, folks. We're going to start seeing some earnings reports rolling in, and we'll be talking more about them in the weeks ahead. Um, I think we are on kind of a pause here as the market is in a really strong uptrend. REITs have been continuing to move higher. So we want to wait for little pullbacks. If we get really lucky, we'll get some earnings related disruptions, which are my absolute favorite because asset real estates and banks asset values are much more important than the cash flow in one little teeny tiny quarter. I mean, cash flow, yes, eventually down the road does matter. You have to have it. But when you get one offs and charge offs and events in the real estate market, they are almost always buying opportunities if the credit is also good. So, anyway, guys, that's what I've got for you. Thank you for watching today. I appreciate it. And I will talk to y'all real soon. Shit. Andrew, sorry about that. I'm good. I'm good. I was just trapped on another call that I had to finish up. So I do apologize. And Wisconsin, huh? Okay. I'm down in Florida. So, yeah, down here in Hurricane Central. Which part of Wisconsin? No, yeah, no, yeah, no. I don't know the area well, but I know where it is. Okay. I mean, you got the Packers, you got the Brewers. I guess that's good, right? Yeah, I used to have some neighbors, some real good friends when we lived up in the Orlando area, and they were from Wisconsin, and they were die hard. I mean, crazy Green Bay Packer fans. It was just absolutely nuts. I guess so. I guess so. Yeah. So anyway, what? How can I help you do what you need to do? Right. Okay. What makes it different is we're using twin momentum, which most people don't understand. They really don't. Most people are like, "Oh, momentum. So if it went up, we should buy more." O- Okay, cool story, dude. But all too often, it went up because it was a story. They're gonna get approval at the FDA. It's gonna get taken over, and you see these spikes, right? Um, and it's just story related, and it's kind of, forgive the expression, complete and utter bullshit. Okay, I figure being from Wisconsin, you're familiar with the concept of bullshit. You know what it is, you recognize it. Um, so it's real momentum is driven by fundamental momentum. Okay, and I understand also that momentum is really a misunderstood concept. The first academic paper on momentum wasn't actually done until the 1990s, which is relatively new in the grand scheme of things. Um, but twin momentum means that you've got fundamental improvements, consistent, constant imp- growth in sales, growth in revenues, strong balance sheet, great returns on equity, new products, occasionally dividend growth factors into it. They're really good companies, and business is getting better all the time, which begins to attract money. It attracts the institutional capital that wants to own the really good stocks that have great growth, and great prospects for additional growth. It is that buying pressure that will make the momentum continue higher. So, what we do differently is we focus on the fundamentals, the credit worthiness of the company. We want to own great businesses that have the potential. As long as they're going higher, we own them. If the fundamentals get crappy or the price momentum begins to roll over, we're just out. And here's the way it'll work, Andrew. It's like half your stocks, you get stopped out for small losses, flat, small gains, and you'll get a couple that'll run 30 or 40%. And then you're going to have this little handful, like, maybe 2 out of 10. They're just going to go like Limbach Holdings went last year, which is a great example because we did recommend it at like 11 and change, and it had exactly the fundamental profile I'm talking about. Uh, you know, Better revenue, improving margins, improving everything. So the stock's at 81, and it's gone pretty much straight up. And that's, by the way, that's kind of the other thing that we're looking for. We want smooth up into the right momentum, right? We don't want a lot of this. All right. This tends to be the story stocks. We just want buying pressure, pushing that thing higher every day, every day, every day. And that buying pressure to be based on constant fundamental improvements. Fundamental, fundamental, and price. Okay. And that's your two drivers. And there's some great research on it. The excess returns are like sick. Um, and in practice, it's worked very well for us. Right. And when you do the story stocks, the minute the story's over, it collapses. You can't. You can't. Look, there's a reason. And I'll just touch on this quickly. We can't go too far with it because it'll piss everybody off. But 95% of all retail traders fail. Yeah, and within a couple years. It's like 1%, maybe 2% are actually consistently profitable. It's a fraction of a percent that can make a living at it. It's Look, close to half of Wall Street traders fail. So you come in to Goldman Sachs, you're the yuppie puppy out of college, and you're the golden boy, and you're getting 150 grand from Goldman plus a bonus if you do well, and they're going to give you every tool under the trade, right? You're going to learn from all the great traders. You're going to have tools that nobody else does. You're going to see all the order flow in the world, and half your class is going to fail. Okay, because it's just too damn hard. But in retail's case in particular, if you go back and you look at the meme stocks and the clinical stage biotechs and everybody trading the stuff that's in the news and everybody's trading the same garbage because it's the hot stock, you're doomed to failure when you do that. If, however, you take the approach of, look, as long as the business is getting better and the buyers are coming in and the stock is going higher, I'm keeping it. Right. I'm not going to try to trade around it. I'm just going to let it go. If you need to increase your rate of return and get rich by next Tuesday, apply some leverage. Right. But if you use the concepts of twin momentum, you're going to hit every big winner. Sure. All story stocks are driven by retail. Institutions don't screw around that shit. They're on the other side of the trade. I promise. Right? I mean, there's a reason Ken Griffin has that house in Miami. It's because dumbasses won't quit trading options and stupid stocks. Okay. And, and everybody's like, oh, I don't pay any commissions. I'm like, really? Because I promise you, about a fraction of that money that you spent, it didn't show up anywhere, but a fraction of it stuck to the market maker's hands going in and coming out. Well, and I kind of tell everybody that go through the Fortune 400. Okay. Just get the issue. I've got one. I think the new one's, is this it? Yeah, here it is. Forbes 400. I got the brand new one sitting on my desk. Just came in the other day. Find me the day trader. And they're like, oh, no, wait a minute. Here's George Soros. If you think George Soros or Paul Tudor Jones is day trading, you're out of your mind, or Stanley Druckenmiller. Now, they do use stops, both mental, and so will we. If it stops working, we're out, right? Capital protection is everything in every strategy. All right. So if it stops working, we're just going to get out. If the fundamentals change, have a shitty quarter, stock just all of a sudden drops off 10, 15% for no reason, we're out. We'll revisit it another day. But like I said, every once in a while, you're going to get an NVIDIA, right? And by the way, I recommended NVIDIA in 2016. Okay. So it's all you need is one or two of those in your whole career, right? And if you go back, I've got this whole string of them that I've recommended for various reasons over the years, because we use rules based investing. And when you have rules and you play by the rules and you don't deviate from the rules, you end up making money because you get all your emotion and bias out of it, and that's what screws you up in the first place. Yeah. Right. We're gonna get It's gonna be a ton of Ohio State graduates in this. Yep. No. Right. And look, you could lose 40, 50% of the time with this strategy. Now we're gonna do everything possible to try for that not to happen. All right. But if we have a 50% win rate and we control the losses on the downside and we let the winners run, we're gonna make a lot of money. Well, I mean, look, there's three things that work in investing, all right, and it's there's three, and everything that works is a variation of the three, and every really rich guy that made it in the stock market used one of the three. Okay, one is deep value, one is trend, and one is momentum. All right, momentum is very successful. It allows you to own exciting, interesting companies. It allows you, a huge measure of control. Like deep, most people, I do deep value with my personal money, family money, and it's been my heritage, so to speak. Okay, it's so fucking boring, Andrew. I will own stocks for years that just sit there and they pay me a little dividend and wave at me once a year with an annual report. Then all of a sudden they get taken over. Right, and that stock now has a compounded rate of return that, more than meets my threshold. Most people cannot do that. There's a reason Munger and Buffett got so rich. Intellectually, and emotionally, they had a dead spot that didn't work, right? So they were able to just sit there and own shit forever, right? And most people just can't. So that, and then trend following just seems to be, I don't know, beyond most people, and I don't understand it because if you're going to trade, you should be a trend follower, and that's going to be. We're going to get into that more and more and more because it's an important concept. And I think we got a lot of traders at Benzinga, in our audience, and I would they ain't making any money. Okay, so maybe if we can change that mindset a little bit, but momentum allows you to have the level of involvement, right? You've got your stops, running the best reports, you're culling the herd all the time because if something stops working or the price action stops going up, you're culling the herd and replacing it with another one. So you're still involved, but you're using a real strategy with real rules, and you're taking your head, your brain, and your emotions, and you're taking it out and you're putting it over here, right? And you're just following the rules. And if you can do that, because it is our emotions and it is our bias and it's our fear and our greed that limits our returns in the market. So if we use momentum, proven strategy, trend in motion stays in motion, all that fun stuff, and the trend is based on the business getting better and growing, and we use rules, then we get a lot of that bias and fear and greed out of the equation. Well, all right. Well, do you have my phone number? Let me give it to you. It's 410-703-1349. So if you've got questions or you need examples, and we look, I have an extensive database. So, if you need new examples beyond what was in that original version, just call me up. We'll get it all together for you. Okay. I want you to have what you need. Don't guess at shit. Just pick up the phone and call me. I'm like, you know, um, it used to be I was sober till 8 o'clock. Now I'm sober all night long. It's a long story, but I hate. Don't go to the doctor; they're assholes. Um, but so if you need something, just don't wonder, don't guess. Call me. It's the idea here. The idea here is to make this as good as we possibly can. So in my mind, I want this and the perfect stock portfolio, which I think you're going to be working on as well, which is a more value oriented strategy. They should be worth way more than the $7 a month. And that's how I think we build the value proposition to the point where everything else that you get is just kind of cool stuff that you got because you took this. And I think that's how we grow this business. Well, that's better than the response and one that I've gotten a lot. When I was working with Agora years ago, every meeting, almost every meeting would be like, "Man, I really can't figure out how to sell that, but would you manage some money for me?" So, so, um, Yeah, I'm glad you like it. And like I said, if you need information, if you need the academic reports and data to back some of this stuff up, just let me know and I'll send it to you. No worries. And have a great rest of the week. All right, Andrew, call me if you need anything.